Good afternoon. Welcome to our 2020 annual client meeting. I'm so glad that everybody was able to make it out tonight, and we have a lot of people viewing online. I want to welcome them as well. My name's Mitch, and I'm going to be your host today. We've got a lot to talk about. Hopefully everybody can hear me in the back and that the speaker's working properly, but we have these annual client meetings are a great opportunity for us to talk about the outlook for the markets and certainly what's going on in the markets currently. We've had a great run in the financial markets for the last several years, and we've had several corrections throughout this run that have scared us all to death a few times, and we might be in the midst of another one right now. I really don't know. We loaded our guns last night. We were here till 1 in the morning getting allocations ready in case we had to sell today. If we saw another violent day to the downside, we were prepared to move to a 10% or move to a 25% cash position today. We haven't done that yet. The market's had a great rally on the opening and then have kind of given that back right now, and we're actually ebbing downward a bit, which is kind of the process of a market trying to find a bottom. But we'll talk a little bit more about that. Today is also an opportunity for us to have some fellowship between yourselves. I know a lot of our clients know one another, and also my team. My senior analyst Kyle Aaron is here. Hopefully you met him on the way in. Also my analyst, more recent addition to the team, about a year ago, Dane May is here. He's one of our analysts and financial advisors. And then the newest addition to our team, Ryan Greco, is here. And he's he's going to head up our client relations team and also participate in working with clients on the financial advisory side too. So hopefully you got a chance to meet Ryan on the way in too. Talk a little bit about our partners and how our firm works. If there's anybody new in the audience who doesn't know it, our wealth management services, and certainly want to talk about our recent performance and what happened last year, where we got our performance from, what it netted out to for the different strategies that we're in, and what's the outlook for the year ahead. Most of you guys know all this, but I'll repeat it for some of the people who are new. I've been doing this for quite a while. I'm an engineer by schooling, but I started out my career in the financial industry in the early to mid-'80s, working for Lehman Brothers and Morgan Stanley. I started this firm in 1991 as an independent investment management firm, and I've been doing it ever since. We have about 300 client relationships. Our average client has about $1 million with us, and they've said, Mitch, make this money last longer than I do. And that's kind of been the job I've been trusted to do, and that's what I seek to do for each and every one of you guys. My job is to try to build wealth, try to beat the bogey, so to speak, too. Our firm has become more focused on performance than ever over the last 5 to 10 years, and I think we've done a relatively good job of creating alpha for our clients. We've got a great environment for success. The addition of Ryan Greco to our team adds another very intelligent, sophisticated, strategic thinking person to our team. He's got great perceptive skills, great thinking skills, great experience, and so we're excited to have him on the team. Obviously, our investment philosophy is all about prudent growth because we're managing people's life savings. However, the investment world's changed over the last decade. For some of my clients who've been with me for 20 and 30 years, who are in the audience today, when you started with me, we were able to get 6 and 7 and 8% on treasuries and bank CDs, weren't we? We didn't have to take a lot of risk. But today, it's not the same anymore. If I wanted, there are no risk returns that are more than 1% in the marketplace, and it's been that way for a decade now. And so we've been forced to embrace risk more than ever, and forcing you to rely upon your advisor's judgment and wisdom to know where the best place to put your assets might be, because risk management is a very important part of what we do. We're trying to improve our communications, and so we've put together some methods through social media to communicate with you. Each and every one of my investment team writes a blog. We'll talk about those in a minute. I write one. Hopefully you've been visiting my blog site occasionally so you can see what's going on. I try to email you links to it when I update something so you can read about it. We've also put together a show called Beat the Bogey. How many in the audience have seen my Beat the Bogey series? Okay, at least half. We put this YouTube show together as a way for us to talk about news flow and what's going on in the marketplace. You know, every week, every day, there's news flow on the market. And we have to, you know, our job is to evaluate that news flow and decide how to make decisions upon it. And what has this corona news meant to the marketplace? We've been talking about this for a month. We've had it, every week we have something new and different to talk about. We just did another Beat the Bogey series yesterday on the Secure Act. How many people are familiar with the Secure Act? New tax legislation that was just passed. The government passed into law in December of last year a new act that affects IRAs. And it changes the way IRAs work. In fact, you don't have to take distributions from IRAs until you're 72 now instead of 70 and a half based upon the new regulations that went into effect January 1. The downside is that you're forced to, excuse me. The downside is that the stretch IRA has been eliminated. And when your children inherit your IRAs, they can no longer keep it in their IRAs over their lifetime, which they could do before. They could stretch it out. Now you have to take your money out of your IRA within 10 years. So we put a whole Beat the Bogey series together talking about the Secure Act, its impact, the pros and cons of it. So if you haven't had a chance to listen to our most recent series, you may want to jump on our website and listen to that if you want to understand what the Secure Act's all about. And we're also tweeting now. Kyle tweets, Dane tweets, I tweet, Ryan tweets. We're all tweeting with comments we have on the marketplace. So get logged in and know where our Twitter accounts are so you can stay tuned into our communications. If you haven't been to my blog, this is what it looks like. I call it the Intuitive View. It's my opportunity to kind of talk about my thoughts on what's happening in the market. I mean, every day I'm trying to add to this picture that I'm trying to paint of where the market's going and where the economy's going. And you know, some days I'm spilling a lot of red on it, like we are today, and other days there's a lot of green that goes into the picture. But every day I'm adding to that picture that I'm trying to build of where our markets and where our economy is going. And so I try to give you good, timely information on my blog. Kyle has a blog. If you haven't been to his blog, you should be. It's very good. It's called The Long Story Short. He's talking about what's happening over the long term, but he's trying to give you more concise information that you can kind of read in 5 minutes or less and understand. He's very good at putting the big picture together and talking kind of strategically in a simple format. So I'd encourage you to go to his blog. And then Dane has a blog called The Starving Market, where he talks about what's fueling the market phase right now and where the flow of capital. So these are all great ways for you to tune in to what my investment team is doing and thinking and where we're going with your money. As I said, this is our investment team. I'm the Chief Investment Officer. Kyle's my Senior Analyst and Trainer. Dane and the addition of Ryan now are our two supporting analysts and our client relations team. And very high quality people who you can depend upon and count upon to get things done whenever you need something done. If you haven't talked to these guys, feel free to pick up the phone and chat with them and get to know them. They'll be reaching out to you over the next year to say hi to. Most of us have kind of sampled all the different services we have, but for those of you kind of forget, you know, we aren't just here to manage your money, although that's my primary job, is to create alpha. But we also provide wealth management services. If you've got grandkids that you're trying to set up college educational funds for, we can help you do that. If you've got estate issues that you want to think about, how to transfer your wealth to your children in the most efficient manner, we can talk to you about strategies for that. When the rules change for tax laws and whatnot, just like the Secure Act, we want to keep you informed on that. So it's a big part of our services, and we do plans for our clients to help you understand how long your money will last in retirement. If you haven't had us do one of our plans for you, we'd love to do one for you. We manage all kinds of accounts, whether it's an IRA, whether it's a 401k, whether it's a trust, individual, joint assets, or 529 plans. We can manage virtually any piece of wealth you have, anywhere it is. Okay? These are the typical partners we work with. We're a brokerage firm. We're not a brokerage firm. We're an investment management firm. And so we work with broker-dealers and other custodians. Schwab's the primary partner that we have for holding your assets, but we also work through TD Ameritrade, Fidelity, Wedbush Morgan, and then Voya now. We manage a lot of 401k plans that are at Voya. Our goals. Every firm has to have goals. Everybody needs to have goals, and our most important goal to me is high real returns. I want to create alpha for you. In other words, if the S&P was up as of last Thursday, the S&P had peaked out at being up 7.25% for the year. And we were up 10.5% on that same day. So we had 300 basis points of alpha last week. Now, today, both of us are about flat. Our portfolio is about flat. We've given back that 10% return that we had just as of last Thursday, and the S&P, which was up 7, is now flat for the year as well. So we've had about a 5 to 10% retracement in the prices of indexes and portfolios, and that certainly has me concerned. I hate to see my alpha be given away, but we have some high growth names that are sensitive to global recessionary fears, and that's what's developed over the last week, is this fear that the coronavirus is going to be the instigator of a global recession. We've kind of wondered what might put us into a recession for quite a while now, and people are saying, oh, well, maybe this is it. It wasn't the trade war, it wasn't Europe slowing down. There's been all kinds of worries for the last decade about what it might be, but none of it has turned into a recession yet. Now people wonder, well, is it going to be this pandemic virus is going to shut down the global economy? So we're going to talk more about that today, obviously. We also have to manage meltdown risk, and this is the most painful thing I have to do is go to cash sometimes when I don't really feel like I want to go to cash. But as I said, we were here till 1 in the morning last night running allocations and preparing sell allocations so we could move to cash today if this market continued in a downtrend. I don't really understand why it's selling off in the vicious way it is, but sometimes I just have to admit I may be disconnected from reality, and I can't sit fully invested without taking action through a severe sell-off. And so that's how we manage the meltdown risk. And it generally ends up being false alarms. We had a false alarm in 2018 in the fourth quarter. We had a big sell-off in the marketplace that kind of ended up being a false alarm, but it looked like it was going to be a real hurricane for a while. And we moved to cash in a pretty substantial manner, and it cost us some alpha. We gave away, we had over 1,000 basis points of alpha in September of 2018, but by January of 2019, we'd given almost all of that alpha back because we went to cash and then the markets bounced. So it's kind of the cost of taking defensive action. When there's a storm on the horizon, I won't leave the sails of the sailboat up. I'm going to bring them down to half mast, and if it gets worse, I'll bring them down all the way, because this is your life savings I'm managing. I just can't optimistically say I don't care. I don't believe I'm wrong. I'm going to just have to admit that maybe I'm wrong sometimes, and I'm going to move to cash. So managing meltdown risk is a big part of what we do. We also want to make your relationships easy and comfortable, and so we've got good client relations people that we've been adding to the team to help you do that. Well-defined financial plans. And more importantly, the investment portfolios we put your money into is highly liquid. I don't buy anything that you couldn't turn to cash within 3 days. I'm not buying you annuities or mutual funds or anything that have big loads or sales charges that would prevent you from getting access to your money should you need it. So everything we have in your portfolio is highly liquid securities that can be turned into cash within 2 to 3 days. That's a very important part of a good investment portfolio. Our philosophy has been the same for 30 years. I've always believed that if you're trying to stay ahead of where people are going, which is really the goal in the investment world, you're trying to figure out where investors are going and get there first, you have to understand what's going on with inflation, central bank policy, and growth, because that's what drives investors' thinking, and that's what drives capital flows. And so we're constantly studying inflationary trends, we're constantly tuning into what central bank policy is, and we're constantly looking at economic growth. What are the engines of growth in the economy? What are the themes of consumption that are in the globe and in America? And by tuning into these themes of consumption, we can decide if the economic growth is sustainable or not, and who's going to ride the train and who's not. What sectors are benefiting from the consumption themes we have today? What sectors are not? So this is all about how we manage money and kind of our core beliefs. Liquidity drives markets, and liquidity is driven by these. One of the reasons why we're in this cycle that seems to be recessionless right now and has highly valued markets is because of liquidity. We've been in this recessionless economy for a decade now, where the economy never drifts off into recession to cause fear or panic and cause people to move money to gold or treasuries. At the same time, the economy has never gotten going fast enough to kind of develop excesses that might make the cycle bust. And so the economy has kind of ebbed and flowed, and so have the markets. And as a result, markets are highly valued right now. Every single marketplace is highly valued. If you're looking at real estate, cap ratios are as high as they've ever been in history. Real estate, highest it's been valued ever. Bonds, the 30-year Treasury just hit its all-time low that it's ever had in history this week. Lowest the 30-year has ever yielded in history, 1.5%, 1.75%. That's the lowest it's ever been. Same with the 10-year, same with the 5-year. And so bonds are highly valued. Stocks are highly valued too, but the cheapest of those three. And the reason why we've had earnings growth through this cycle. If you look at how real estate is valued, it's valued based upon the multiple that real estate sells at relative to its earnings. That's called the cap ratio. Stocks, the way you value stocks is looking at the PE ratio, the price relative to the earnings of the underlying company. PE ratios on stocks right now are in the 18 to 19 range. All-time highs were achieved of about 25 to 26 in 2000. So we're still 10 to 20% below the all-time highs in valuations for stocks. So stocks look the cheapest of those three asset classes. The other asset classes that we consider for investment dollars would be commodities or cash. Commodities are very cheap right now. It's the one asset class that's cheap. Why is it cheap? Because we don't have any inflation. We haven't had any inflation in a long time. Oil is at $50 a barrel, right? It was 140 when the economy was strong 5-10 years ago. Whether you're looking at steel, copper, aluminum, even soft commodities, grains, because the globe is so soft, the demand for commodities is low and commodities are very cheap. This is a cheap asset class we could move into, but why would I want to be in oil right now with the globe soft? Why would I want to be in steel and copper and aluminum? I just don't see this great strong cycle of growth out on the horizon yet. If we start to see that, I'd love to be there. But we're just not in a cycle right now that seems to be sustaining itself enough to where we're going to develop inflation yet. These are the 5 asset classes we utilize, and through the 5 phases of an economic cycle, you've seen me emphasize each and every one of these heavily in your portfolio. We're very heavy in stocks right now because it's the cheapest of the 5 asset classes, and because I don't see a recession on the horizon. If I felt we were in the 8th or 9th inning of this ball game for the economic cycle, I would not want to be in stocks. I would want to be in fixed income and commodities, being gold. Gold. If we're in the 8th or 9th inning of this ball game, it's time to be in treasuries. It's time to be in gold. I don't think we're there yet. But the market's worried about that, isn't it? The market's suddenly thinking maybe we are in the 9th inning and this cycle's going to end here, and as a result, gold's been going up like crazy, And treasuries are at an all-time high in price and an all-time low in yield. So the marketplace is worried. When we do finally fall into recession, you will see gold move another 20 to 40%, I believe. And I think you will see treasuries move another 20 to 40%. You'll probably see negative yields of 30-year treasuries of 100 basis points, just like you have in Germany and many other parts of the world right now. When this cycle ends, if it doesn't end in a bust and we just slip off into recession, yields on treasuries are going to go negative by at least 50 and maybe 100 to 200 basis points. There'll be a lot of money to be made in gold and treasuries when we start to feel like the end of the cycle is there. I don't think it's there yet. I don't think the coronavirus is going to be the catalyst that puts us into recession. I think we'll get through this, but we'll talk about that some more today. How did we do last year? We had a great year on an absolute basis. All of our accounts did absolutely fantastic if you look at their return. Dynamic growth up 31.2%. Wow, that was fantastic. If you had $1 million account with me, it finished the year at $1.3 million. Wow, pretty amazing. Even our dynamic income, our more conservative strategy, was up 29% last year. Our diversified equity portfolio was up 34% last year. Our growth strategy, which is all U.S. stocks, up 31%, and even our fixed income strategy was up 12%. Was anybody unhappy with their performance they had last year? Nobody was unhappy. I was unhappy, I will tell you though, because of one thing that didn't happen. We didn't have great alpha last year like we did the year before. The S&P was up 31% last year. We didn't beat the S&P, and that was disappointing. We were ahead of the S&P for for the first quarter of the year, but then we had a few problems with a few names in our portfolio. What were they? Can anybody remember? What were the names that we had trouble with in the portfolio? Crystal Kokendorfer says Boeing. Yeah, Boeing certainly melted down during the year, didn't it? We've had trouble with Boeing. What else did we have trouble with?
We had trouble with Dell.
Dell we had problems with. Although Dell is not a big piece of the portfolio, and as much as Dell didn't really go anywhere, we haven't made any money on it, it tries to rally and then it gives it back. It's a 1.5% position, so really not meaningful. Boeing is a 2.5 to 3% position, not meaningful. What's our big position in the portfolio? Apple. What else? Amazon. Amazon's 10 to 15% of your portfolios. Anybody pay attention to what was going on with Amazon last year? Although while the S&P was up 31%, Amazon was not up 31%. Amazon had a rough year. They had their first, when they reported second quarter earnings, it was the first time ever in the history of the company that they missed. They missed their earnings estimates. It was mostly because they were spending a lot of money investing on next day delivery and on their prime shipments and increasing costs. And people were concerned that they were just spending too much on cost. And so Amazon did not move in the way it's been. And it was our biggest position in the portfolio. And when you have 15% of the portfolio, lagging the market, you're not going to beat the bogey. Amazon had been one of the reasons why we had over 500 basis points of alpha in 2018 and over 1,000 basis points of alpha in 2017. But last year it was a contributor to the reason why we just matched the S&P 500. We had a problem with another name in the portfolio, Netflix. Netflix is a big piece of our portfolio. And Netflix saw some increased competition last year from the likes of Disney, Roku. Everybody decided to get into Amazon's business, didn't they? And the world worried. Wow, can Netflix really hold the market share? Do they really have the ability to maintain this market share? And so Netflix, which was a $350 stock, corrected all the way down to $220 during the year. But eventually Netflix kind of showed that, well, you know what? We got our name on every remote, on every TV that's manufactured. We have a strong market share that's hard to replicate. We've got a great business model we're executing on, and they reported terrific subscriber growth in the last quarter internationally, and the stock is back at all-time highs again now. And so it's part of the reason why we had 300 basis points of alpha this year, but it was part of the reason why we lagged the market last year. So we had a few problems last year, but they're starting to fix themselves because the two big names in the portfolio lagged. The second biggest name, though, helped us, Apple. Apple had a great year. Apple had a fantastic year. It really wasn't because the company was doing so great, though. It was really more because people started perceiving this stock as a value stock. It had gotten so cheap over the previous few years relative to what it was earning that value managers decided they wanted to start to own this stock. And it was under-owned in the marketplace by value managers, and they've been buying it in a big way. So let's talk about the outlook, or let's first talk about what's been going on in the economy and the globe, and whether it's likely, whether this nirvana situation that we've had for 7, 8 years is going to continue. As I said, we've been in this recessionless environment where the economy ebbs and flows. Doesn't get going strong enough to bust, and it doesn't get going weak enough to kind of slip off into recession either. And that's ideal for financial markets, and it creates highly valued markets. But in order for that to happen, you've got to have low inflation. You can't have high interest rates. The reason why assets are so highly valued right now is, if you're going to take your money out of the stock market, what are you going to do with it? Where would you go with money right now? What looks better than stocks? If you're going to buy a piece of property, you're going to be buying at cap ratios at all-time highs. If you're going to buy commodities, there's no inflation. Why would you be optimistic about buying oil here or commodities of any type? If you're going to buy treasuries, well, you're hoping yields go negative because they're already down to 1%. So they're at the highest value in history, so that doesn't look good. What is exciting that could cause people to say, I'm going to take my money out of the stock market and do something new with it? There just isn't. There just isn't any good choices, and that's why all of these asset classes are staying highly valued and are likely to stay highly valued until we get inflation. When this cycle finally does start to rumble, and I'm not sure when that's going to be. Maybe it'll be in Trump's second term if he's reelected. And if we get a Congress that'll work together to create some good programs, capitalistic programs to help our economy grow at a faster, more sustainable rate, then we might have some faster growth that actually might make the economy bust at some point. But right now, the economy is not going fast enough to create excess capacity. Nobody really wants to ramp up their capacity to make things, given the outlook. That's what causes the cycle to bust. When companies start to get too optimistic, what is it, irrational exuberance that Greenspan called it? When irrational exuberance sets in and people start adding capacity to their businesses that don't make sense, eventually when the reality sets in that they can't use all that capacity, they have to start laying people off and shutting down plants and everything else, and that overhang busts the cycle. Well, we don't have that right now. In fact, we have themes going on in the economy to the opposite. Who is the biggest part of our population today? We've got people in the room for the most part are baby boomers, right? Baby boomers are 55 and older. That's most of this room. That used to be the biggest part of the population. Then people 45 to 55 are called Generation X. And then people under 45 are millennials. What's the biggest part of our population now? It's millennials. They are the biggest part of our population. So whatever you've got to watch the giant, right? The millennials are the giant in the room right now. They're not the wealthy giant, though, that the baby boomers are. The baby boomers aren't as big a population as they used to be, but they're very wealthy. So watching what they're doing makes a lot of sense. Millennials aren't as wealthy, but they are so big, their consumption means something. Millennials have a completely different way of thinking than Generation X or baby boomers, though, don't they? What have we learned about millennials in watching them over the last decade? How do they think differently? They really don't want assets. They really don't want big homes or big cars or Rolex watches. They want experiences. And they're not as ambitious as the baby boomers were, and so they're not willing to they're not as entrepreneurial and not willing to kind of get in the mud and fight for in a capitalistic manner. They're kind of embracing socialism more than capitalism, and they have a sense of entitlement that has been talked about, and so all of this does not contribute to strong consumption or kind of the underpinnings for a capitalistic cycle. And they're living in apartments, not homes, aren't they? And so there hasn't been a housing boom as a result. We've had a 10-year cycle with interest rates at almost 3-4% for mortgages, but yet baby boomers aren't buying homes. One, they can't really afford them because they really don't want to embrace the work ethic and to make the money to do it. And two, they prefer experiences. They'd rather go to Costa Rica on a great vacation, or they'd rather go on a cruise or go to Las Vegas and gamble. They're all about experiences. And so that's a whole different cycle of consumption that we've had to tune into, and it's changed the path of the economy. And so it's changed the path of our investment philosophy. In fact, we're investing around it, and it's changing what's going on in the world, and it's kind of created a damper on inflation. We really don't have any inflation anywhere in the world. Whether you look at America, CPI has been 2% most of this year. Okay, we don't have much inflation. China doesn't, Europe doesn't, Russia, emerging market, nobody has really much inflation to speak of. If you look at a graph of inflation here in the US, you can see 2.5% or less for the last year. Last time we had inflation that was high, went back to the early 80s, late 70s, where we had 10% or more. And then in the 80s, we had some 5% inflation, but it's kind of been in a steady decline. Without high inflation, you don't have high interest rates. Without high interest rates, you don't have competition for stock market money or risk money. So inflation is pretty tame in the world right now. Because the globe's not growing at a strong rate, and two, there's a lot of underlying themes that are technologically driven that are keeping inflation down. You know, we continue to use devices and all kinds of technology to replace people in the marketplace, and it's keeping prices, the cost of producing things low. Central bank policy, another key part of forecasting where the economy is going to go. We need central banks to keep interest rates low because we've got a very fragile economy. If we've got inflation in the marketplace, they're not going to be accommodative, number one, or if they've got something internally going wrong with their economy, they might not be friendly. But, you know, central bank policy in America has been very friendly. It was rising. In 2016, the Federal Reserve raised rates about 7-8 times, taking Fed funds all the way from 0 up to 2.45%. But then when the trade problem developed in March of last year, the Fed realized, we might have overdone it with rates. Globe started to look like it might be slipping backward again, and so the Fed started lowering rates again, and it's brought Fed funds down to 1.5%. And in fact, the market is anticipating the Fed's going to cut again here at the next meeting, and Fed fund futures now are selling at around 1.25%, which would put it right down in here. In other words, erasing half of what the Fed raised rates over the last year and a half. So, central bank policy in America is very friendly, and in the rest of the world, it's even friendlier. Germany has their bank rate negative right now. The United Kingdom has their central bank rate negative. So they're actually, you have to actually pay them to take your money. How about the outlook for growth? Let's talk about that. Is there a reasonable outlook for growth? As I said, the outlook for growth revolves around consumption themes, engines of growth. Every good economic cycle has themes that drive it, consumption themes. What have we got going on in our economy today and in the globe? Is there some great consumption themes? Every good cycle has had it. The last cycle, which was, really great growth, was from 2002 to 2007, right? And it was all about housing. Everybody was buying homes and cars and big ticket items, a second house, a third house, a rental house. Anybody with a pulse could buy real estate and fill it up with furniture and get credit. And so that was the theme that drove our economy. Not today, though. Not at all. So we don't have that. In the 80s, Ronald Reagan was spending money on defense and weapons and trying to outspend the Soviet Union and win the Cold War. Great theme of consumption. A lot of people in the audience were part of it as you worked for companies like Raytheon and Rockwell and Boeing who made weapons and saw your paychecks and bonuses benefit from all of that spending. But we don't have that now. We're not really in an arms race right now with anybody. So that's not a great consumption theme. But what we have is we have experiences. How do you invest around that? We've struggled. We know this is a consumption theme. We know the millennials like experiences. And so who benefits from that? Travel is one of them, right? So what does that mean? It means cruise ships. It means airlines. It means hotels. So we started looking at that. We decided to invest in that. It means even Starbucks is benefiting from, people like to congregate at the Starbucks, and that's the reason why we added Starbucks to the portfolio. After we had that first notch down in the Royal Caribbean from 130 to 110, we added a little bit to that. Well, it was too soon in hindsight. We haven't had the courage to buy a hotel or a casino like Wynn. We haven't had the courage to buy some of the other areas of the marketplace that are benefiting from experiences. Millennials like to go out to dinner. They love to eat, and that's an experience. But we haven't found that investable. They don't like the Cheesecake Factory. They really don't. I mean, the big name corporate brands that you can invest in with restaurants are not appealing to the millennials. They like these kind of small restaurants that have character and are unique. They won't go to the big corporate brands. And so you're actually seeing the Cheesecake Factory and names like that in decline right now. So not a great investment area because of what's going on in that theme. Digital devices, we're all keeping up to date with our phones and devices, and everybody's in it. When you go into the doctor's office, he's got a digital device. You go to the store, they're using devices for managing inventory and checking out. Everybody's embracing digital devices to manage their business, and so the companies who enable that are great investments, and we own a lot of semiconductor stocks. We own the SOX, which is an ETF that focuses exclusively on semiconductor companies and is benefiting from digital devices. Cloud computing is another thing that's going on. Everybody's moving their computing to the cloud. In fact, you can't even really buy Microsoft Office for a desktop anymore. The Microsoft Office you use is one that's run over the web. And Google has kind of their version of Word and Excel and everything that you run through Google, and it's even free right now. So cloud computing is a theme. Apartments has been a theme as the millennials have been living in apartments. The millennials are starting to, the biggest segment of the millennials are starting to get a bit older though now. As I said, millennials are people 25 to 45. And if you looked at where their population is heaviest, it's heaviest from age 40 to 45. That's the biggest concentration of millennial population. And you know what? They've been living in apartments for 15 years, and a lot of them are finally starting to embrace home ownership, actually. They're finally starting to nest and have kids. They've waited a long time, but now at 35 to 40 or more, they're having children, and they're starting to wonder, do we really want to continue to raise these children in an apartment? And so the demand for first-time home builders is there, and we're seeing companies like D.R. Horton, which builds startup homes, as looking very attractive. Great company, well-positioned for what's going on with baby boomers. We're just not sure we can buy it, though, in that I generally don't want to buy individual stocks unless they're well-established companies who are kind of superstars. Now, I want to own a superstar, and I want to own it I want to know more about it than the average guy. But I don't want to take rifle shots with kind of small companies that aren't really a superstar, haven't reached superstar status yet. So I've been uncomfortable buying D.R. Horton, even though it's well positioned for what's going on. And so I've been looking for a way to buy housing in a diversified manner without having to buy the old name builders like Lennar and whatnot that still are buying the big homes that are not in demand. So we haven't found our way into that area yet, but we hope to. What else? Is there any other thing going on? What do you guys see going on in the economy, consumption-wise, that might be a theme?
Entertainment.
Crystal says energy.
Entertainment.
Oh, entertainment. Yes, entertainment. Is it investable? Yeah, that's a lot of what's going on with themes. They're not really investable. How do you invest in entertainment? Well, Disney makes movies. You could invest in movies. Disney is competing with Netflix. Netflix, we have participation in entertainment through Netflix already. I've looked at some of the producers of live stage, profitable area, but haven't really found a player who's investable. Music. Yeah, music is popular, but once again, how do you invest in it? How do you find a way to kind of leverage that and invest in it? Beth?
What about the share economy, like people that Uber, Lyft, not WeWork, but where people rent their own cars out, where they use technology to rent Airbnb, they're renting their homes, their cars to other people. That sort of microeconomy.
Beth is saying, yeah, there is this theme of people kind of services and whatnot that are being utilized by the millennials and now by Generation X and even baby boomers too, like Airbnb and TaskRabbit and Uber Eats and all of these things. Yeah, those are some names, but they're kind of smaller, less well-known names, still kind of a younger area, but we've been looking at an ETF that invests in them that we think could be investable. So we think we have found an investable way to get involved in that sector.
About medical.
Medical is the question. Volatile area, you know, United Healthcare is one of the biggest holdings in our portfolio. It's been a great performer. We've made several 100% on that name over the last 7 years that we've held it. Continues to crank out great earnings growth, but it's been threatened by socialism and you know, Bernie Sanders has talked about, you know, a one-payer system and all, and so United Healthcare was a $300 stock that got knocked down to $220 when Sanders and Warren and some of these people looked electable 6 months ago. And then all of a sudden that party didn't really look like they had anybody who was electable, and United Healthcare rallied from 200 all the way back to 300. Now all of a sudden Bernie's doing better. He is, you know, he's won Nevada, New Hampshire, Iowa, he's won some areas, and he looks like he may well be the front candidate, even though, you know, he talks about some pretty extreme stuff that you wonder how he can really do. The threat of Bernie becoming president is a problem for healthcare because he wants to take away corporate participation in healthcare and get government involved in it more. And you know, we worry that all of a sudden healthcare could become like the post office, where it's just, you know, doesn't make money. But there's, yes, Crystal?
Environment, companies that are going green and pursuing a clean environment.
Crystal asks, is there a good outlook for the environment and companies that are participating in making the environment better? We've been looking at one. We've been looking at a utility. Kyle, help me remember the name of the utility.
Yeah, it's
Xterra? Xterra. There's a utility in Florida that focuses on green energy and solar, all kinds of different energies, and they're just doing an amazing job. Unfortunately, oh my God, is it valued highly? It sells at 25 times what it earns, and it's only growing at 9% a year. And so the valuation of it is so high, I just don't know if we can make money on it. We looked hard at that company. We love their business model and what they're doing, but the stock has risen from $20 to $100 over the last 3 years as they did it, and so we missed it. We kind of missed that one. And most of these areas, people are excited about, the environment and clean energy, but solar, all of these names are highly valued right now. Highly valued names that it's hard to get comfortable with. Well, if we're starting to think about, is our economy going to... One of the things we have to worry about now is, are we on the verge of a recession? Right? Is this economy going to slip off into recession? Because if it is, we got to get the hell out of that 90% stock position. We cannot sit 90% invested in stocks if we're going to... The next move for the economy is recession. So I've got to look long and hard at what's going on in the economy. And the first thing I have to look at is consumer confidence. You generally will not see economy slip into recession when consumer confidence is at all-time highs. And we're kind of there. The consumer confidence index all-time high is 137, which it achieved last year. It's at 130 now. Confidence is still very, very high. Even with these risk of the coronavirus talk, the last reading we got a couple weeks ago was this 130.7 reading. So consumer confidence is still quite high, which bodes very well for this economy staying on a path of growth. Even though consumers get worried about things, they have not stopped spending altogether. They certainly have stopped spending on travel. I was talking with Bob Kurzian, and he was planning to go to Singapore on a trip in a couple weeks, and he says, well, I don't think I'm going to go now. I don't want to be out there in that Asian world where that coronavirus is right now. I'm probably going to put that trip off for a year. And so there is part of our economy that's in a bit of trouble. How is the corporate world doing? This is where the bigger problem has been. Consumers have been spending, and fortunately 75% of our economy is driven by the consumer. And only about 15% of our economy is driven by what corporations do with their spending patterns. But the Purchasing Managers Index has been in sharp decline since September of last year. The index was at 60 in September of last year and went all the way down to 47.8, but it's now started to rebound a bit. And we've started to develop some pent-up demand for manufacturing and industrial equipment that we hadn't been buying in a while because the globe was kind of soft. And most of the industrial equipment that's made in America is sold abroad, and China's been soft, Europe's been soft. America's kind of been this island of prosperity where the rest of the world has been soft. And they're the ones who buy so much of the industrial equipment that's manufactured in America. So PMI index has been where the worry has been. Exports, even though we've had this trade war, we really haven't seen our exports changing. We're exporting about $150 million a month from the U.S. And it's been relatively stable. It rose significantly in 17 and 18. It's been volatile, but our exports have really not changed significantly. Retail sales at an all-time high, 356 million per month. This is what retail sales have been averaging and continues to grow. So this is another sign the consumer is sound and healthy. But we got to take a second look at the coronavirus. How many people listened to our Beat the Bogey episode we did about a month ago on the coronavirus when it first broke out? Few of us, not many, okay. We were optimistic that the problems of the coronavirus would be overcome, that it would probably be a setback for the marketplace for a while, that it was going to hit some sectors of the economy quite hard, like gambling, hotels, airlines, cruising, any area of the economy where you congregate. Disney's theme park in China was shut down. The whole area of Wuhan in China has been shut down. Can't get in or out of that area. But we went back and we spent a lot of time when we looked at what's happened with viruses historically. And the last coronavirus that we had in the world was called SARS. You remember SARS? That came out of China as well. And same sort of virus that kind of begins in animals and mutates to humans. Fortunately, China has kind of been a problem for the world in that they kind of let this sort of stuff go on and to the point where it just puts the whole world at risk. And they haven't had the kind of food administration that they need to kind of make that a stable environment there. But SARS was a big outbreak that took place in 2003 and into 2004, but it kind of burned out within 6 months. The death rate of it was higher than the current coronavirus. I believe the death rate was around, Kyle, 6 or 7%? 10%, got as high as 10%, but it wasn't very infectious. It didn't spread at a high rate. And in fact, China was quite good at shutting down the area where it started with and containing it, and it never, within 6 months, the virus was pretty much gone. It had some short-term effects on travel to China. It had cruise liners hurt, airlines hurt. Everybody's getting hurt now, got hurt then. But when we looked at it, all it really did was create pent-up demand for all of that. So everybody who was going to travel ended up traveling all the more 6 months later or a year later. They put off their cruise, they put off their airline trip, but they eventually did it, and everybody kind of got that back. It hurt some industries. It hurt cruising for a while. It hurt airlines for a while. They had setbacks in their earnings, but it did not put the globe into recession, more importantly. In fact, the global economy barely budged from it. China's economy slowed, but the rest of the world really didn't budge. And so it seemed reasonable to believe that that might be the case again. But we're taking a second, we spent the last week taking a second look at our analysis and saying, well, did we miss anything, guys? And there are a few things that are different. In 2003 and 4, when SARS hit, China's GDP was $4 trillion. $3 to $4 trillion a year is what was the size of their economy. Today, their economy is 13.8 trillion. They're a much bigger economy today than they were then. That has some meaning in this, doesn't it? It means there's a lot more interaction with what China does than the rest of the world. They were kind of a smaller player. In 2004, global GDP was around $40 trillion, and they were 10% of it. Okay? What's global GDP now? Anybody know? It's 80 trillion. Global GDP has doubled. $80 trillion is what we did in global GDP last year. China is 13 of it. So now they're about 15% of global GDP from under 10 before. So they're a bigger contributor to global GDP. In fact, they're 16% of global GDP. Share of global GDP, they're 16%. They were 4% before. So they have a more meaningful impact on the world because they're a bigger player in the global economy. Now we got to look at what's going on with imports and exports in China. If you look at the import and export situation, you find some things that are a little alarming as well. Exports out of China. Well, in 2003, they were less than $1 trillion. No. Help me, Kyle, with the numbers. Value of exports in trillions. Share, China's exports were about $500 billion in 2003. Today, China's exports are... That's not right. What am I missing, Kyle? Help me. What is this graph telling us? It's telling us the blue line is China's exports as a percent. Speak up.
2.5 trillion. We went from 500 billion to 2.5 trillion.
2.5 trillion is what their share of exports is today?
Right.
Okay. You talking about the top graph? exports of goods out of China. Share of global exports is 12%. Oh, it's the other side. I got it. So now China's exports are 2.5 trillion of their $13.8 trillion of total exports. Sorry for that confusion. So they export a whole lot more than they used to, don't they? So they're interacting with the rest of the world. What do we know about China right now? What has the coronavirus done to China?
Shutting down the factory.
Has it? Yeah, we're not quite sure to what extent, but we know much of China has been forced to stay home, right? This, and they've been able to do it. In a communist society, they've got quite. And where people don't have human rights like you do here in America or Europe, they said, look, do not go to work. They kind of, like the whole area of Wuhan is shut down and nobody's going to work there. And so if you're dependent upon products that are coming out of Wuhan for your business here in America, you're not getting them. So this has been a problem for different businesses. Apple has said, look, a lot of the products we use to manufacture our phone are made in China, and all of a sudden we're not getting them. And at the same time, because the Chinese people aren't working, they're not buying our phones either. And so they guided down estimates dramatically as a result. So China's a big player in the global economy. And when SARS hit, it wasn't a big player. It didn't export a lot, and it wasn't as big of an economy. It's a bigger player today than it's been. And so the threat of this coronavirus bringing the globe to its knees is much higher than we originally thought. Yes, Bob.
Won't it affect the supply chains? Isn't that the big underlying issue? The supply chain will be disrupted, and people will start taking it out of single points of failure and have multiple sources.
Yeah, Bob's point is the real issue here, supply chains in the world for production of things are being interrupted, right? Just whether you're Boeing making airplanes or Apple making phones, you're dependent upon pieces of your product coming from all areas of the world. And it's one of the downsides of how our economy has globalized, right? In that, countries have become very specialized. And, like China's the major manufacturer of the world's services, and some components are made exclusively in one area. If that area of the world becomes, constrained, impacts the whole globe. And so that's kind of the problem we're dealing with right now, and we're trying to get our hands around, and why the market's not sure about it, and why we've had this volatility. China's economy, we got to look at that. China's economy has, every mature economy is heavily is heavily made up of consumer services. Their consumer services has grown from about 40% in 2003 to about 52% today. Their industries has shrank a bit, though, believe it or not. They're not as big a manufacturing engine today as they used to be, believe it or not, in terms of the overall economy. They don't produce a lot of agriculture, do they? As big and vast as China is, much of it is kind of not farmable land. They have all of this kind of hilly, rocky land that's really not conducive to agriculture. And so there's not a lot of agriculture that comes out of China. But what they really do is produce a lot of goods, and they produce a lot of services that are mainly consumed by their own population now. They don't really produce many services that are exported. They're not a big exporter of services like America is. America is a huge exporter of services, whether it's business services, technological services, consulting services, business management services. We do that. They do not. Their services are food and just kind of taking care of the consumer needs of their own population. there's been some cuts to GDP as a result of the coronavirus. Singapore cut its GDP forecast from 0.5% to 2.5% to 0.5% to 1.5%. Japan's cut theirs. Germany's cut theirs. The French have cut theirs. Some of these areas of the world that are affected by the global economy, or affected by corona, are cutting their forecast for growth. We know tourism has kind of been shut down. Hong Kong was seeing 200,000 visitors per day in February. Now it's less than 3,000. Oh my God, nobody's going there. Flights to and from America and from these other countries have been canceled through the end of March. It's a little hard to make up these tourism services. Bob and I were talking about this earlier, and that a lot of people who are planning to travel to Asia and maybe to parts of Europe that are affected may just not do it, may just end up going to Florida here or Las Vegas or doing something domestically instead and might not take that trip. So that's what we have to weigh into our forecast for the market. Equities are still the asset class that's the cheapest in the marketplace, and the reason why we're there. But we have to stay tuned into what's going on, and we have to watch carefully what's happening with the coronavirus, and more importantly, how it's spreading. We're anxious to see it decelerate. It has already decelerated in China. There's been a significant deceleration in the spread of the virus within China, which is what we expected. But now, it's spilled out into the rest of the globe a bit. We saw a big increase in cases that were reported in Italy, also South Korea, Iran. And, the market sell-off over the last 3 days was basically a vote of no confidence in those countries' ability to kind of create a safe environment for the rest of the world and to prevent the spread of that virus in their country from occurring. So we'll have to just watch this carefully. As I said, we've got our guns loaded and we're ready to move to a 25% cash position quickly if this sell-off continues on as it has begun the last few days. It really looks like a great place that we should be buying some of these companies. And if I could get my confidence to do it, that's what I'd like to be doing, is buying an airline stock here, buying more Royal Caribbean sometime over the next few months. I think it's too early still for the rest of it. Buying a casino company like Wynn, buying more Starbucks, buying some of these companies that are being pummeled by this, and taking advantage of this weakness. That's ideally what we want to do, and we just need to get the visibility that this virus is starting to be contained and then quickly jump on before these companies kind of get away from us. Because when it's really clear, stocks will be back to their all-time highs, no doubt. There's a lot of optimism out there about, the global economy and the financial markets. As I said before, equities look great. Fixed income, not so great. Real estate, not so great. Commodities, not so great. If you believe that the cycle's going to continue. When we think the cycle's going to end, though, this is where we want to be, fixed income. We also want to be in gold. They'll go a lot higher. Even though gold's moved, it will go a lot higher when the cycle ends. What questions do you have? What did you come here hoping to have answered that I didn't cover? Anything? Bob has a question.
You got a loss and you lose your cash, what, 25%? Is 25%, is that enough to if the market really tanks?
That would be our first step. No, it would be not be enough, but that would be our first step. We kind of have a rule that I follow, and when the market drops 10% below its 60-day moving average, when it crosses that point, then we're going to move to cash. Okay, the S&P 500's moving average is around 2850, 2900. It's at 3150 today, I believe. Okay, so we're still a few hundred points above that. But if the S&P 500 crosses the 2900 level, we will make our first move of taking 25% of the portfolio to cash. Okay, and if it continues, then we'll take another 25% to cash if we drop another 10%. I don't believe the fundamentals are in place for doing that. We've done that a few times over the last 5 years, and every single time we've done it, it cost us money. It didn't make us money. It always proved out to be the wrong decision. We kind of sat through correctly the trade war problem when Trump was really fighting with China over tariffs and whatnot. The markets had about a 7 to 8% correction there for a while. And unfortunately, it didn't push us out, and we didn't get whipsawed. But in December of 2018, we had a 20% correction in the markets, and we went 10% to cash. And that storm blew away quickly, and by the time we got invested fully again, we were getting invested at prices that were 5 to 10% higher, and we left money on the table as a result in 2018. We gave away all of the alpha that we had achieved. We were 1,000 basis points ahead of the S&P 500 in September of 2019, and by March of 2018, and by March of 2019, we were dead even with the market. We gave all that 1,000 points of alpha back because we had to go to cash. We do really well when there's steady trends in the marketplace, and we can use our wisdom and judgment to find out who's riding the train and emphasize the areas of the economy that are benefiting from the themes that are going on. We're good at identifying that. We're pretty good at weighing what's going on in the economy with people's fears and when to pull the trigger and when not to. But at the same time, when there is volatility that just happens, that's cost us some performance. It's just part of managing risk and part of the price we have to pay to, I've got people's life savings in stocks. I can't sit here and stubbornly just stick to my guns that this isn't going to turn into a major problem. Yes, Beth.
What about with the upcoming presidential election? Does that, are there sort of avenues if Trump wins versus the Democratic nominee that affect thinking?
She's asking how do you take into consideration the election that's coming up, and how does that affect maybe an investment plan and your investment policy? And I think typically it might not, but I think because corporate or America is so sharply divided between kind of conservatives who are capitalists and liberals who are very socialistic, that a Bernie Sanders is, I don't think he's going to be good for the economy, and that people would very much worry that he's going to put us into a recession quickly. And so I would expect if he starts to look electable, that would be a reason to start getting out of stocks. The more Bernie Sanders looks electable, the more I don't want to own equities. I would want to own gold and treasuries. I don't see him being a major threat yet myself, but he certainly has gained a little bit of ground in the public's eye. We'll just have to see. What else? Well, I'm going to be here with my team for the next 15, 20 minutes or more, so if you have questions you want to ask us, hang out and we'll chat as long as it takes to answer all your questions. Thank you all so much for being a good audience, and I enjoyed the event hopefully as much as you did. Thank you.